A lot of land investors are not losing deals because the market is too hard. They're losing deals because they don't know how to value the property properly. If you cannot understand what a piece of land is worth, then you just cannot make a smart offer. You either overpay and you create risk for yourself, or you offer too low and you never get any traction with your marketing. Valuation is one of the most important skills in land investing. So in this video, I'm going to break down how to think about land value the right way. Now, most beginners want a simple answer, and this is not completely their fault. A lot of information out there tells you how simple land is. And while it is true that it's simpler than other forms of real estate, it doesn't mean that it's just click a couple buttons and you have everything you need. A lot of people want to go on Zillow or a similar site or some sort of software and just have it spit out a value to them. They want a formula, they want a percentage, they want a simple shortcut. But honestly, land does not work that way. Zillow and other online estimates are often unreliable for land and for houses. County assessed values are not market values. Asking prices on land are not what they sold for. And two parcels that are right next to each other can have completely different values depending on access, utility, slope, zoning, restrictions, and what the buyer demand is for that area. And softwares that are designed to basically spit out a value for you do not consider those variables that I just mentioned. So instead of guessing, you need a valuation process. So when it comes to valuation, I look at three major things. First, sales comps, then what's the regional demand, and finally, site usability. The first part of land valuation is comparable sales. But with land, comps are not always obvious, right? You're not just looking for any land sale in the area. You want the properties to be as similar as possible. Similar acreage, similar location, similar access, similar utility situation, similar topography, similar zoning, similar use, and ultimately a similar buyer pool. And recent enough that the data still means something. See, a 5-acre parcel with road frontage and power nearby is not the same as 5 acres that has no legal access. A flat, buildable lot is not the same as one with a steep hillside. A property that's inside a subdivision that has a lot of restrictions and high HOA fees is not the same as some unrestricted rural acreage. A wooded recreational parcel is not the same as a recreational desert lot. If you treat all land like it's the same, you are going to misprice the deals. Another mistake that people make is that they rely way too much on active listings. Now, listings can help you understand competition, but they do absolutely nothing to help you prove value. A property listed for $50,000 does not mean that it's worth $50,000. It could just be wishful thinking. It could sit there forever. Sold comps tell you what the buyers have actually paid for those properties. Listings tell you what the sellers are hopeful that they can get. You do need to know the difference. See, when we value land, we want to understand the actual sale prices. What are similar properties really selling for? How long are they taking to sell? Are buyers paying cash for them? Are sellers offering seller financing? Are the properties improved, buildable, recreational? Or are they some sort of speculative deal? That's where real valuation starts. The second part is regional demand. Now, this is where a lot of people miss the much bigger picture. A property can look cheap compared to other listings, but if there's no buyer demand for it, it's still not a good deal. You need to understand who wants to buy that land in that area and why they want to buy it. Are people buying for recreation? Is it for camping, building, long-term investment, a subdivision, farming, hunting, off-grid living, commercial use? Are they an adjacent owner? Development. See, all of these things are different buyers, and different buyers create different values. So if you're targeting an area where people want weekend recreational land, the value drivers may be access. How many trees are there? What are the views like? What are the water features? What's the terrain? How much privacy do they have? If you're targeting buildable lots, well, the value now is being driven by zoning, utilities, road frontage, soil, setbacks, and what the proximity is to the growth. If you're targeting infill lots, the value may be tied to development potential. If you're targeting larger acreage, the value may depend on whether or not there's subdividing potential, what the access is, what the timber's like, what the topography's like, and the regional buyer demand for a property that size. The bottom line is you cannot value land properly without understanding the buyer. That is why I do not like and never rely on generic pricing formulas. All of those things ignore demand, and demand is what creates market value. So the question is not just what is this land? That's what so many people focus on, but the questions are who would buy this land? Why would they buy it? What other properties are they going to compare it to? What else is out there, basically? What problem does it solve? That is how you start thinking like a real land investor. The third part is site usability. Now, this is where land can sometimes get tricky. Two properties can be in the same area, they can have the same acreage, and they can have completely different values. Why is that the case? Well, because one may be usable and completely desirable, and the other may not be usable at all. So you need to look at a lot of things, such as legal access, physical access, road quality, meaning is it paved, is it gravel, is it just there on paper, utilities, zoning, whether or not it's in a flood zone, does that matter for the area, wetlands, topography, what are the soils like, what's the shape of the property, are there any restrictions, are there any easements either to get to that property or across that property? What's the buildability of that property? What do surrounding properties look like compared to yours? See, a parcel may look fine on a map, but it may be almost unusable in real life. Or, as I've seen numerous times, the opposite can happen. A property may look plain at first. You may be questioning it, but then when you dig in, you understand the use, the buyer pool, and the location, then you realize, wow, it's much better than others may realize about it, and even better than other properties around. And that's why due diligence and valuation are connected so much. You cannot separate them. Access affects value. Utilities affects value. Zoning affects value. Slope or topography affects value. Wetlands affects value. Taxes affects value. Restrictions affect value. Buyer use affects value. If you ignore any of these things, then you are not truly valuing land. You're just guessing, you're speculative, and doing so can get very expensive very quickly. So how do you value land like a pro? Well, the bottom line is you need to combine all three things that I just mentioned. Sales comps tell you what similar properties have sold for. Regional demand tells you whether buyers actually want that kind of land. And site usability tells you how the specific property compares to everything else in the market. Now, that's the process. Now, it's not completely perfect. Nothing will ever be. No valuation method will ever be perfect, no matter what anybody says. But it gives you a much better framework than just looking at Zillow or a similar site or the county assessed value or some valuation software or a random percentage of retail value. Once you understand value, you can make better offers. You can negotiate better. You can avoid bad deals. You can explain the property better to your potential buyers. You can choose the right exit strategy based on it. And you stop relying on speculation and hope, but rather on real world numbers. Now, inside the Land Riches Blueprint, we go much deeper into all of this: valuation, pricing, due diligence, offer structure, how to think through all of these land deals before you actually buy them. Because if you get valuation wrong, everything else becomes harder. So if you want that full system, our calculators, our worksheets, and the processes that we use to evaluate deals, then do yourself a favor and go check out the Land Riches Blueprint. The link is below in the description. But you need to stop guessing what land is worth. Guessing just creates more and more problems, and it's going to cost you time and money. So you need to learn how to evaluate it correctly.